everybody. Thanks for joining today. We have today David from Cambrial. Pleasure to have you today.
Having me on.
I'll give a quick intro to David. So David is the CIO of Cambrial Capital, an investment firm specialized in constructing and managing portfolios of hard-to-access funds across the digital asset space. David has been researching and investing in the crypto space since 2013 and sits on the advisory board of Global Digital Finance, a SRO, engaging policymakers and regulators to advocate industry best practice in crypto assets. David holds an MA in history from the University of Edinburgh. Welcome here.
Very thorough. Thanks.
So do you want to just give a brief intro to yourself, about your company again, and maybe give us an intro or your thoughts on the market, where you think it's going, what Bitcoin is going to do the rest of the year, or if you have any thoughts about that.
Okay. So I started getting interested in the crypto space back in late 2012, early 13. The angle for me was very much kind of, I'd done a lot of economic history, which I'd read at university. And this was kind of in the context of the European debt crisis, et cetera. Sort of came to Bitcoin that way, started to really digest the white paper, which took about 6 months. And then sort of had this thought that what Bitcoin was really doing as a network was it had created a mechanism to coordinate work on a massive kind of scale. And that was very useful and important if you want to have an internet money.
Yeah.
But it was also kind of generalizable. And it was this idea that you could take this mechanism and transpose it onto lots of different problems over time, that we knew that the internet actually had. And then nothing happened for 2 or 3 years. I mean, you had essentially in 2012, 13, you had Dogecoin, which was a joke, but was the number 2 cryptocurrency, I think, maybe for Litecoin. And so you had Litecoin, and people were really taking Bitcoin and tweaking like 1 or 2 parameters, and that was it. And then Namecoin came along, and that was interesting. So that was basically what Handshake is today, but trying to have a new DNS system. But nothing was really happening. And by 2015, I was sort of saying, one day this is going to happen, and someone's going to take the ideas and use them for lots of different problems, and things will get interesting, but that might be in 5 years or 10 years.
And did you go all in, I hope, in 2013 or 15?
No, not all in. It was, Bitcoin was crazy back then.
I know.
I mean, I remember meeting a guy in the street and buying Bitcoin off him. And you just made a PayPal transfer. Okay. In the UK, there was few ways to do it. So that's how I started buying some. And I put a little bit of money in. I was young and didn't have much capital. And I think it would have been a bit nuts to just max out the credit cards. But I regret not having done so.
Yeah.
And so, by 2015, I started to just focus on other things, was working pretty hard and didn't have much time for it. And that's obviously when the whole next wave started, which I completely missed. And so if I was averagely early to Bitcoin, I was very late to Ethereum. But by the time I took notice, which was somewhere in 2016, when all over the press, and I'd missed everything, it was like, shit, we actually have a second generation of protocols here, and this is like a massive enabling layer. And that's when I sort of decided to go full-time into the space. It felt like it was the right time. It took me about a year, but in 2017 started working on Cambrial. And we've been sort of officially live for about 2.5 years. And the angle that we took was to say this is an exceptionally complex space, exceptionally fast-moving space, and we need to sort of partner with experts, in a sense. There's going to be lots of different things going on, and even if you just look at the venture space, you're probably going to have experts in ZK tech, you can have experts in kind of Web3 type stuff, you can have experts in what is money, and what are the protocols enabling money and finance. So it sort of made sense to build a kind of a basket of different allocators. And this concept of fund of funds is a very old one. go out and find specialists and sit on top of that and really understand the whole landscape. Find the areas you think are the most attractive ones, and then go and find the best manager in the world doing something in that space.
Yeah.
And this has been done in new asset classes kind of again and again and again. And as the asset class is very young and poorly understood and hard to access, it's an interesting approach to the space as an investor. And as the asset class matures over kind of the subsequent decade or 2 decades, it becomes comparatively less interesting. But I think today it really makes a lot of sense. And so that was kind of the inception of Cambrial. Brought on 3 wonderful team members to cover kind of risk, venture, and an analyst. And we started building a brand, meeting with managers, and here we are.
Cool. Okay. So yeah, that's quite a journey, right? And you haven't answered the question how you see Bitcoin going forward. Just to round up the initial intro. So end of the year, any predictions?
I've not done any Bitcoin predictions
of today's price.
So, yeah.
No predictions.
I haven't done a Bitcoin prediction in a long time, like since it was really, really low. And I kind of feel comfortable making one now, not necessarily on the price, but just looking at what's happening in the world. I look at Bitcoin and I'm almost thinking like either this thing explodes in the next 2 years, or it's failed in its narrative as a digital gold, because the conditions have never been better. This is literally what it was created for.
Yeah,
I think that if you look around, we have, the entire world economy came to a standstill. Every country's debt just exploded, or is about to. But the tax receipts are going to drop to like so violently. It's not going to be anything we've seen before.
It's going to be pretty. Yeah,
like that's already baked in, and so your deficits are going to explode. We've had handouts like we've never had before, at least from what I've seen. And so that kind of deficit imbalance is going to explode. And my personal view on this, not that I'm qualified to have one, but is that the US is really the only country that can do that. They are sort of the risk-free rate, and they can print money till kingdom to come. And they have done so, and they'll continue to do so. And I think, at least in the kind of short, medium term, they will not be penalized for it. I think that is not true of basically any other economy. Maybe Japan, maybe China, but that leaves, the UK can't just go and print money without having some impact on its currency.
Yeah.
And so I think we're going to see this sort of liquidity crisis, which we've had, which was papered over with enormous amounts of money printing by central banks everywhere.
Already in the past, right? And then
that's already kind of baked in.
Bigger, now.
But at some point, you just have a debasement of the currency. You just do. And the dollar, because all currencies are comparative and relative to each other, I think the dollar is the big winner out of that. I think money will flow to the dollar and to the US. Part of that will be a sort of safe haven play. The other one is just purely structural. There are trillions and trillions of debt in non-US denominated economies, which is denominated in dollars. And there has been, and I think will continue to be, a flight for dollars. You're going to have to acquire dollars in order to pay your liabilities. So I think you get this big move into the dollar, and that causes probably a succession of emerging market kind of currency crises. And I think at that point, you start getting inflation in small local currencies, and you start moving people into Bitcoin as a hedge against those, because they can't access dollars.
Yeah.
And the interesting thing, sure, that will happen to gold as well, but Bitcoin is such a smaller market that it doesn't take that much to really move it. And so you only need this to happen in a few small emerging countries for Bitcoin to really rock it. This is not true of gold. I think on top of that, you kind of layer the, safe haven play of Bitcoin as basically your ultimate hedge against like monetary and fiscal irresponsibility. It's harder to confiscate Bitcoin than it is to confiscate gold or confiscate something that's sitting in your bank account. So I think you sort of layer that play on top of it as well. I might be completely wrong, but at least personally, it's kind of very long Bitcoin.
Cool. Awesome. So let's leave it here for that introduction, and let's dive into Cambrial and what you guys are doing there. Obviously, we're coming out of March, right, which was a very interesting month. Hi, Cyrus. Thanks for joining. And so, you know, what do you think we have learned, right, after March? I mean,
a lot. I think the big lesson that we learned was, and this one hasn't been resolved. I think there are a few where it's kind of accelerated developments and fixes. But the big one that we haven't touched is the problem with collateral in kind. And so if you are going and trading on BitMEX, you're depositing collateral in Bitcoin to go long on Bitcoin, but it's Bitcoin against USD.
Yeah.
What that means is that as the price of Bitcoin drops in USD terms, the value of your collateral obviously drops as well. And so your increase in leverage actually accelerates as the price of Bitcoin drops. And most professionals knew this. Well, every professional knew this, but it's sort of like, how much did you actually know it?
And follow it, right?
And follow it, because if you're a professional and you look at the space and you want to be very cautious, you run a back test and you say, well, what's my maximum possible drawdown?
Exactly.
And then you say, well, let's look at a stress test. And let's say, I want to stress test my portfolio and never have to worry about a liquidation. So what do? Well, maybe you take the highest daily drawdown ever in Bitcoin and you double it. And if you had come to me and said that's how we're stress testing it, I wouldn't have said you're totally crazy and you're way too aggressive. That sounds like a very reasonable, cautious thing. If you'd done that, the max daily drawdown since 2016 was about 17.5%. If you double that, it's less than the 40% drop that we had.
It's the classic, right? It's the classic 2 or 3 Sigma events that, of course, only happen once in a century or once in 1,000 years. But then in financial markets, you have those 2 times a year.
But 2 or 3 Sigma events is fine. I'd say you should probably be prepared for a 2 or 3 Sigma event, because in crypto the tails are fat. This was a 10 Sigma event.
Exactly, right?
So the probability as a percentage had like 23 zeros after the decimal point.
Yeah, so it would not basically
impossible.
It shouldn't have happened since the dinosaurs, right? So not even since the dinosaurs. Exactly. Yeah, that's brilliant. That's a good way to put it. Yeah.
And so the magnitude of how much of a black swan this was in crypto markets is sort of enormous. And so if you had a normal sort of basis trade on, and you were sitting on BitMEX or any other exchange where your collateral is in Bitcoin, and you're against USD, and you put on a 3x leverage to take care of, to do a basis trade, which is very, very reasonable. No one would ever sort of tell you you're crazy for doing that. If you did that and you have a 20% drop in the price of Bitcoin, your leverage goes from 3x to 10x.
Yeah.
During that time, the liquidity has probably evaporated because the market makers have left the market, because it's an abnormal event.
Yeah.
And so the price at which your position will actually get liquidated grows above the index price.
Yeah.
And so these 3 things basically compound. And if you had a move from 3x to 10x, you probably just get liquidated.
Yeah.
And so that's essentially what happened. And so we had this sort of first wave of liquidations where we had a 20% drop. And then, at least from what we've been able to put together, that second wave was sort of caused by the OTC desks, sort of more manually calling around to clients and margin calling. And people were unable to post margin because the mempool had exploded and the Bitcoin network was overloaded. The exchanges themselves were overloaded. So even if you did get your Bitcoin transaction through on the network, it didn't mean that on BitMEX, which is where the most liquidity was, didn't mean that they would actually credit that to your account in time.
Yeah.
So you had all of these things kind of compounding.
Yeah. So I think let's just dive in and look at the data really shortly. I'm just going to present here one screen, Chrome tab, this one, just to look at it together. So what you're talking about, so this chart basically shows the performance of the market, Bitcoin, and the several indices that we are tracking, like a small cap index or a trend index. And since we launched Protos in 17, right, end of 17. And so this is $1 invested, and the orange line is Bitcoin. So this $1 invested right now is down to as of yesterday to roughly 50 cents, right? Let's call it 50 cents. 20,000 back then, now it's $10,000. And what's certainly interesting, and what you're now talking about, is this drop here in March, where you see the orange line dropping in a day from 44 to 28 cents, right? I mean, and in the lows it was even lower, right? So we were really talking about half the price of Bitcoin really took a 50% cut. And what I think is really interesting, and first of all, well, this is a very sharp cut, right? First of all. Secondly, we had this experience in 2018 as well, right? In 2018, Ray knows this really well, because I think we talked about this last time when we had the webinar. This was really when he launched as well here. So it was a really tough time, and Bitcoin was trading around $6,000 levels, and then it dropped down to 3,000. But if you look at it closely, you see, well, this was not in a day, right? This took actually a week or so to kind of mature. So it was like 11:10 at 6,000, and then it took whatever 10 days or so to like really go 50% down. Whereas in this year, this was really like 1 day move, right? And this is exactly what you're talking about, and this also manifests in the volatilities, right? So if you look at volatilities in the markets, which we track here on Protos Terminal, is Bitcoin now is already coming down to 68, but it was way above 100% volatility, right? What that means is the annualized volatility of 100% or more means, right, one standard deviation would be it can double or it can go to zero, essentially, right? And now you're talking about something which is a 10 sigma event. So obviously that's a lot more than what you would normally expect.
This is super helpful. Yeah, so what happened in Bitcoin markets was crazy and historic, but we'll sort of get on to, I think there's a few conclusions to have. But on the ETH side of things were even more, I think, kind of exciting and interesting. And I don't want to get into that because I know you've got, I think, Freddie coming on for your next talk. And Freddie will be able to tell the story of what happened in DAI way better than I can.
Yeah. Okay. Well, maybe you want to give like a brief introduction to what happened there.
Yeah, basically you had the same effect as in Bitcoin. You had a massive kind of cascade of liquidations in Ethereum, and then this caused DAI. I don't know how many people are crypto noobs or not here, but a stable coin.
Everybody's pretty proficient. Yeah.
Okay. Cool. Yeah. Well, so like, I don't know if I can add much. I would just say like come for the next one, and Freddie could maybe like walk you through exactly what happened with how these contracts got undercapped.
Yeah,
and how someone scooped up like $8 million of ETH in a week in one go, so $0.
Yeah, and I mean, we talked about this with Lasse Clausen a couple of weeks ago on the webinars. We talked about the DeFi space. We looked at how you collateralize DAI, right, and then you collateralize Ether, for example, and then collect DAI. And of course, and we can actually check this out here on Oasis, right? Let me just call this up here. What was the immediate result, right, of this drop was, of course, that if you want to borrow in this space, then you want to basically, you have now the option of posting stable coins, right? So let me just connect your wallet, MetaMask wallet, the usual stuff. We've seen this already in the last webinars. And now you want to borrow. That's me here, manage vaults. And where can I generate? Here, but this is only DAI. But I want to deposit. I want to deposit now USDC, I think is the new currency they're offering. Well, for some reason, I don't find it right now. Here it is. Okay, so here's the collateral type, and they have immediately introduced. So they always had Ether, BAT. Well, they added BAT more recently. They also added more recently Wrap BTC, which is I think super interesting in this space, because this will make Bitcoin as now you'll be able to post Bitcoin as collateral and draw dollars out of it. But the most important, of course, coming out of this crisis was, of course, adding USDC, right? Because something that also holds the dollar value against the DAIs, right, and which therefore does not fluctuate with the market price, right?
Mm-hmm.
Yeah. So and then we'll talk to we'll talk about it next week, or when we and talk about this in more detail. Cool.
So
learnings from March.
So the learnings I think what's interesting is that crypto markets had a kind of seismic event, and we spoke to a client relationship manager at one of the big exchanges, so the people that are handling all of the kind of institutional accounts, and he lost like 75% of his clients in like 4 hours. Like every single one, just 75% of them just got wiped out, 100%.
Wow.
So it was a big move, but there's a couple kind of things to point to. The first is that crypto markets, unlike every other institutional asset class, cleared without a central bank and without a bailout. And I don't know that that can be said of fixed income, of FX, of equities. You can't really say that anymore. And I think this kind of lays to rest the argument that at least relatively crypto markets are kind of manipulated and fake. And so I think that's sort of the first really interesting thing is things held up pretty well compared to the other big market events that we've had, even back in 2019, but 2017, 18, like it was a real clusterfuck. Sorry. Things held up pretty well. And I think that's a big thing that people, sort of a big narrative people haven't been pushing up crypto and should. The other thing is that remarkably few funds got wiped out by this. People generally, given the severity of the event, did pretty well. It's been difficult for us to find more than a couple examples of people that really got screwed. So that's good. And then it just accelerated a few developments that were already happening, but that make the space way better. So the biggest of those is off-exchange settlement. So like Copper released Clearloop, and Coiny are about to release a similar product. Fireblocks, same thing. But this is the idea that you can just deposit the coin in like a regulated, insured custodian, and then the exchange will have their own account at that custodian. You basically move the assets over, and the custodian basically acts like a prime broker, and you get credited on the exchange itself, and you can trade there. But you don't have any counterparty risk.
Nice.
And that's really accelerated this, which is awesome, because it reduces the hurdle rate as I think about an investment, because my required return of an investment is much higher because I have to go and deposit coin on BitMEX, and it's not regulated, and I don't know what's going on, and I don't know if it'll still be around tomorrow. And so your hurdle rate goes down, which means that either you're making just as much money as you were, but this is a far more attractive investment, or investment returns will go down, which they may, as more money comes on. And the other is that volumes shifted possibly permanently to like better exchanges. Huobi is now the largest exchange by volume on derivatives.
Crazy,
Huobi is probably a better credit risk than BitMEX. And that just happened like that.
Amazing.
So it's been net good, and I'd say really good for the crypto space, where it could have been pretty catastrophic.
I agree, right? I mean, like, compared to everything, financial markets, S&P selling off 30-35%, right? And then, Bitcoin selling off, let's call it 50% from, let's say, or 60 maybe, right? With a volatility in Bitcoin, which is always, like we just showed on the terminal, right? Is about whatever 6 to 10 times higher than an equity market. It's amazing, right? I mean, I also agree. Yes, definitely there were problems on the derivatives exchanges like BitMEX, but on the other hand, the market itself held together really well. And let's hope this continues, right, in the near future. Let's let's continue to one last question from my side, and then I want to open it up, to the participants. So, obviously you're running a fund of fund, right? You're seeing a lot of different single funds, their performance. What do you think is the biggest opportunity set today, right? Like, where do you think, what's the biggest opportunity?
I think from a commercial perspective, it's different to from a returns perspective. So as an individual, kind of small, unconstrained investor, I think the opportunity set looks kind of really different. And I think that we've learned a couple lessons over the past years looking at the space. I think crypto today is, in the actively managed strategies, is pretty non-institutional in the sense that it's just going to be the way you would optimally invest capital is going to be really difficult to get past a sort of, investment committee at some institution that really doesn't understand the space and is worried of every new innovation or twist that you might have on investing, whether that's, the actual like asset or instrument that you're using, or the thesis or the market you're in, or something like this. So the first thing is, I think the best opportunities at the moment are at the edges of the crypto space and are very poorly understood by investors outside the crypto space. And that means that they're very hard to raise capital for, but that's kind of what makes them a great opportunity.
So like, can you give an example? Like what?
So if we turn up with our fund of funds and a kind of institutional process, we have a kind of 4-page checklist of 70 different items that we need an investee manager that we're going to give capital to. We need them to tick every single box. And there's a lot of boxes there. But a lot of the best strategies in the space are, and Philip, you know what a pain in the ass it can be.
I've kind of went through it. So
a lot of the best strategies are kind of at the fringes and have very little capacity to them. So like, I think the stuff you've been doing on hash rate derivatives is super interesting. Good luck trying to go sell that at an institutional scale.
Even scale at all, right? I've started now trading, since, I don't know if you're aware of this or everybody else here, that so we were structuring mining in the sense that you buy machines, then you sell the hash rates, and then you sell the Bitcoin price. And if that combination of prices is cheaper than what you can get for it, then of course you're interested. And the interesting thing is FTX launched two weeks ago now the hash rate futures, and I've started trading it from personal account for testing, and of course, right, it's extremely illiquid. So that's one side. It's just starting. But on the other side, what is super interesting, it follows the Bitcoin price really closely. And this was one of our main assumptions, if you remember, right? That the hash rate will follow like the predicted hash rate in 3, 6, 9 months. And this is what the futures are trading at. That this will be basically Bitcoin, like this will be today's level of difficulty plus a premium. And then plus the movement of Bitcoin price. So Bitcoin price goes up, they all go up, right? The curve shifts up, and Bitcoin price goes down, they shift down. And this is, in fact, at least since the first day of trading of this hash rate future, this is exactly what's happening. So it's really amazing. And there is also a premium for us, right? For the hedge fund that's supplying, that is selling the future, so selling risk. There's a 6% premium in it for 2 months, which I think is a fair deal, right? I mean, we've looked at it, and so you're getting a 6% premium out of this trade for 2 months, but you're facing the risk that, of course, this hedging with the Bitcoin price is not perfect, right? That's So I'm basically continuing that, and it's quite interesting.
That stuff is fun, but there's an enormous amount of assumed knowledge. If you look at hash rate derivatives and trying to understand what the risks are, you need to understand intimately how the mining process works.
It's bad.
What the mining industry looks like, kind of the supply chain of it, and how it's funded, and the CapEx requirements, and why miners need to do this. So if you're going to a family office or an institution that barely understands Bitcoin, this kind of stuff goes right over their head.
Well,
I think that's where you either need a real relationship of trust. You basically need somebody to give you an unconstrained mandate, and they need to give you a balance sheet I think the Goldilocks zone of it is sort of between like 2 and 20 million. If you want to go and do this niche stuff. And so this is kind of an adult, sophisticated family office environment, rather than an institutional one. And it's not to say that there aren't opportunities for institutional investors. I think that their demands are basically like, hey, go track Bitcoin and reduce the volatility for me.
Exactly, right? Fair enough.
That's absolutely fair enough and wonderful. But it's not the highest alpha opportunity in the market today. And so I think that there's sort of this divergence between like doing something that is commercial and doing something where you can make the most money kind of dollar for dollar. And I think today those things are pretty different. And to an extent, this is really just true in every market. But I think it's really true here. Like where crypto meets the real world is sort of a mess. And there's lots of opportunity there.
Really, what do you mean with that?
Primary issuances are always a mess. Whether it's, like of the famous ones like EOS, had this kind of daily auction mechanism and you had these massive ARBs every year.
Yeah, I know.
In the primary and secondary market. It was nuts.
Yeah. But it was brilliant, right? I mean, it was such a marketing. I mean, I remember, so we met the guys of EOS before they launched the EOS sale, and it was literally when we did our ICO. So we announced our ICO in New York at the blockchain conference or something in I would say August 17, right? So we thought, okay, we announce it, we thought it's a good story, and basically the guys that were big prominent in the event, and I didn't know them yet, right? Were the EOS guys, and then back then it was called differently. What's the holding structure behind it? Exactly, Block One, exactly. And so what was cool is, I met the guys there. They were still pretty, pretty humble, also raising up. But obviously, they were funding the, themselves, right? They put a lot of money themselves into the EOS fundraise. And I thought, wow, it's amazing, right? I mean, how these guys are pulling this off, right? So a lot, and billions of dollars later, right? And I'm using EOS. I'm trying to, I'm looking at, like you said, right? We're doing a lot of niche investments in the DeFi space and trying to generate yields. And EOS, we're trying on here EOS, but quite honestly, I don't want to step on anybody's toes, but I really think it's like years behind what Ethereum is and the DeFi space. But still interesting.
So primary issuance, like EOS was a famous one. You've got Freddie and I looked briefly at one, like a Handshake did an airdrop, and airdrops are wonderful, but they did an airdrop to the top 100,000 websites in the world, like according to the Alexa ranking.
Really?
And our idea was sort of like, I wonder how many of these domains have expired and are available. And if I can buy them for $10 and make $2,000 in Handshake tokens, like that's a pretty good return.
Yeah.
And so I sort of called up Freddie and was like, "Am I crazy?" And he was like, "That's fun. Let's look." And then we found out someone's actually done it already. So someone beat the punch. Yeah. And I think they made a good return on that. So very good for them.
Good idea.
Again, it's sort of like the real world clashing with the crypto world kind of dreamed up in a basement somewhere. Then there's like liquidations and bankruptcies, and there's tons of stuff finally coming online from the ICO boom. Lawsuits kind of getting settled and distribution starting to happen. That's sometimes you can just find a cash box where you're buying a claim and it's just cash, and you can do a 2 or 3x on that, and your only risk there is really duration. The Mt. Gox trade is a super well-known one, but it's crazy interesting right now because of where the price is and the kinds of discounts you can get.
It's still live, so how does that work? Like, you want to walk us through?
Yeah. How long do you have? Okay, so Mt. Gox.
So you have like 3 minutes, I think, and then we should kind of open it up. So.
Okay. So Mt. Gox has a unique feature. It started off as a bankruptcy. And in a bankruptcy, you sort of take a snapshot, at least under Japanese law, you take a snapshot of the assets at the moment of the bankruptcy, and that's what everyone is owed. And they then get kind of returned their pro rata of whatever kind of the cash value of their claim was. And so they started that process, but over the kind of subsequent 2-year period, Bitcoin went up something like 20x. And the bankruptcy proceedings found themselves in this interesting situation where they had far more assets than liabilities. And what would have happened under that is that the assets would get distributed back to the shareholders, which is to say the guys that created the mess.
Yeah.
And that was obviously not going to happen. And so the claimants petitioned the trustee to convert the bankruptcy from a traditional bankruptcy to what's known as a civil rehab.
Yeah.
And in a civil rehab, the equity holders get cut out and excess assets get distributed back to claimants.
Mm-hmm.
And so you have this situation today where if you buy a claim for, say, 10 Bitcoin, you'll buy it and you'll say, I'll pay like $1,000 per Bitcoin in the claim. So you'll pay $10,000 for the claim. You'll actually get $7,000 worth of cash that is already sitting in a bank account in the Japanese trustee's bank with your name on it.
Beautiful.
You get $7,000 of cash, which effectively limits your downside. And then you get some free Bitcoin. And you get it at such a discount that this beats buy and hold. If you hold it and the Bitcoin price doesn't move, you beat it, obviously, if Bitcoin goes to zero. And if Bitcoin moons, then as it moons, you outperform at an increasing rate. We've got this kind of free convexity to it with the downside protection. And this is something you just can't explain to people. But if you're in the space and you're comfortable taking on Bitcoin risk for an unknown period of time, because you're probably hodling anyway, this is something that just makes enormous amounts of sense.
Sure.
So I think you've got a lot of kind of these special weird situations lying around that you can do with amounts of capital.
Yeah, and I mean, I think it all comes back to kind of, first it was the exchanges failing, then it was ICOs that were struggling, right? Like you said, there are lawsuits going on, there's restructuring going on, right? So, for example, I mean, some ICOs raised tons of money. The product that they wanted to launch, nobody really needs anymore because it already happened, let's say, on Ethereum. Mm-hmm. And, like what they do, then they have literally 10, 20 million in cash, right? We're a happy client. We are happy, we're happy about it because this is money that we can manage. But on the other hand, it doesn't really make sense. And, probably they will have to kind of either give it back to the original token holders or come up with a new story, right? So there's a lot of stuff, I think, now unraveling, right? After, let's say, 2017, 16, 17 craze, or maybe into 18. Cool. But let's open it up and see if are there any questions for you from the participants here. Sure.
Hi, yeah. Sorry, I was just it's Freddie here. Yeah, I was going to almost play a tumbleweed sound there. It's always the classic diffusion of responsibility when you're asked to ask a question. Yeah, David. Sorry. Obviously, with your with your particular insight into quant funds, alpha generating funds, and the research you've done at Cambrial. I'd spoken to at least a couple of people who said that there were a few funds that went down as a result of the 10 Sigma event. How much would you say that was a result of issues with kind of BitMEX APIs? And do you think that these, like you said, better, higher quality exchanges with Huobi, you gave as an example, will just keep coming through? We've seen CME option interest grow and things like that. Like how much do you think it was a technical fault more than a risk management fault? Although I imagine they all fall into the same category in some form or another.
Yeah, good question. So BitMEX's trading engine, you have to give them this, is probably the most robust of all. It does really well. The parts that break down at BitMEX are actually like not the matching engine itself, but the in this case, they had we heard of two kind of major issues crop up across multiple managers. One of them was Bitcoin that they managed to get through to the exchange was not getting credited in time, which you can absolutely imagine being a possibility. And the other one was kind of liquidations that shouldn't have happened. So one manager that we had a profitable position that got liquidated, and that obviously just should never happen. As a reminder, when you get liquidated, 100% of your position gets put into the insurance fund, so it's 100% loss for you. This was like a small part of their book, but they lost like 5% of AUM on this, and so they had to go back to BitMEX and say, like, what the hell? Like, how is this even possible? How did this get liquidated and why? And it took them like, about 2 months to actually get a resolution with BitMEX. And when they did, all of the money that they could have made off the back of this evaporated. They got back kind of what they'd lost, but that was it. So on BitMEX specifically, it wasn't the matching engine, it was the other pieces that broke down. And on some of the other exchanges, we heard about like, perpetuals getting mispriced for reasons unknown. So, like Binance will publish exactly how the funding rate on the perpetual will actually get paid. And you can go and you can sort of look at that documentation, and you can also ingest the same data that they do. And based off of that, you can say, well, the funding rate according to their calculation should be X, and it turned out to be Y. And so that can screw on with all sorts of strategies. So you had lots of little things screw up all over the place, which caused losses, but you had very few. I only know of 2 actual funds that got fully blown up by this, out of quite a lot. And I think it could have been more. And market structure, especially when it comes to the trading engines, actually held up much better than it has in other times of crisis in the past kind of 24 months. I was kind of pleasantly surprised.
Cool, thanks.
Yeah, I mean, I agree, right? I mean, they're like, what do you think? How many funds are out there in total? Crypto funds?
We've got about like 450 logged, but actually actively trading, we've got about 50 kind of market neutral.
And 450 funds are trading?
No, about 50 like with a really active market neutral trading strategy that fits into the bucket that we look at, and then kind of 450 across venture and everything else.
And everything else.
Yeah.
Got it. That's actually a pretty large size, right? If I don't know how many hedge funds in totally are there, like 8,000 or something.
Yeah, 7,000, I think.
So 7,000 hedge funds, and then you have whatever 500 are crypto. Let's say I would still call that in the hedge fund bucket, because that's definitely where we are still, like alternative investments.
Yeah, a lot of these like single-digit million, like aren't hedge funds, but
yeah, that's true. Okay,
they exist and have capital. But yeah,
cool. Yeah, I mean, any other questions from the group here? Ray must have a question. No, kind of opposing theories from last week.
I speak to David so often that I don't have questions.
No, that's good. Give him a pass. All right. Cool.
Maybe I have a question. Maybe David, you talk to a lot of crypto funds and all the different institutional players. How do you see it? You see like it's usually like the very smart guys like Philip and Ray that were essentially in hedge funds or in fund of funds and went into the space because they just thought that there's more to be done and it's a greater purpose, or you just see mainly a lot of kids that are like 20, 23 years old and just start up a crypto fund, got the 2017 great bull run, and now they're just managing like 1 or 2 million and that's it.
Yeah, so those guys die pretty quickly because the costs of having a fund are quite large, and it's not worth it if it's going to be low single-digit millions for most things. It really depends on the strategy and the vintage of the fund. You had a lot of crypto funds come out in 2017 and the beginning of 2018. A lot of those were, kids, or not necessarily in age, but in experience. A lot of those died off. A small minority of them made so much money in 2017 that they suddenly had the AUM. Like they didn't raise $50 million. They grew like $3 million into 50, and they suddenly had the balance sheet and the management fees and the performance fees to actually be able to professionalize. And they sort of took the opportunity of the like January 2018 crystallization to take like $2 million and just plow it back into the business. And they hired like real adults and built a real business. And those are now some of the big franchises that we have. Very few people did that. Like maybe I can only think of 2 right now. And then if we look more towards like what's been happening in 2019 and 2020 so far, the funds that come out are really good. the number of crypto funds coming out per month has dropped, but the quality of those funds has gone up a lot. And in our space in market neutral, the prototypical manager that we're seeing used to run money at a hedge fund running strategy X, and they looked at the crypto space and said, hey, wait a minute, I can do the same thing, use that same skill set, but in a different market with a ton more volatility and inefficiency, and we can make a lot more money and have a lot more fun because it's smaller and more entrepreneurial and more exciting. So we don't see kind of kids that much anymore.
Right. And by the way, sorry, Fabio, I didn't see you were in the call. Fabio as well, a very talented investment manager here. Other question, you see a lot of like former CTA guys or, systematic guys in general that come in with great strategies. And then there's some more niche strategies like Philip is, I think so. He's doing a lot of cool things. Maybe it's passion of his PhD is always to find something new behind it. I don't know where that comes from, but but I'm wondering, do you see like really good fundamental crypto pickers, like the guys who said like people got like 3 years ago say, yeah, Chainlink, that probability of those guys growing up, it's going to be there, those type of stock pickers that like go into funds or mainly.
Yeah. No, not at all.
Yeah.
When I look at like really high quality long short managers in the equity space and try and compare like the depth of thinking, the depth of research, how they build conviction positions, how they build portfolios, understanding the nuances between long and short, they are not mirror images of each other. Like they're vastly different. The quality of their thinking around like when to sell, it's way behind. It'll come, but it's just not there yet. And I think that's kind of a product of two factors. The first is we don't have robust fundamental valuation models for this. So a lot of it is narrative driven. And if you take a fundamental short position on something and the narrative goes against you, you can just die. And so you have this skew towards long only, and it's difficult to have short-term fundamentals. The fundamentals may matter over like a 5 or 10 year period, but in that time with your kind of quarterly liquidity hedge fund, you're gone. So I think the best fundamental analysis that we see is actually coming out of venture funds, but they're long only. And so stock picking like quarter to quarter, you don't have this kind of reinforcement loop that's strong enough, like a quarterly earnings call, to push kind of the stock price up or down. So the feedback mechanism, I think, just isn't there yet. And I've forgotten the second reason.
So last question, I'm sorry, taking all the time. So when you say venture funds, so for you, it's like a long only guy, it's like a venture fund essentially. So Pantera, which has like, I don't know how many funds they have, but let's say they're buying out, different utility tokens or different other whatever protocols, this and that. Those are venture funds for you today. Is that correct?
Like I would still put like Multicoin, which is a long short manager, pretty much in the venture bucket because they're at least trying to make long-term kind of venture-driven decisions. And by that, I mean like these are fundamentally technology bets. They are very long duration. They're looking for a thesis to work out over like 3 to 5 years. Even if they've got an open-ended fund, they're making kind of technology-driven, longer-term investments. And I understand why people would want to run a venture-like strategy out of an open-ended fund, and we're not dogmatic about that. We don't really care about the structure as long as the kind of conditions around that structure match well the manager themselves and the strategy they're trying to do. The problem with an open-ended fund is you don't have called capital. So if you're a venture fund, you raise the fund, and when you find something good over a 4-year period, you call up your investors, you say, give me some cash, I know where to put it. In an open-ended fund, you have to be allocated. So if you get inflows, you're not going to say no to them 1 month to the next. So that money's got to go somewhere, and you might have to buy a little bit of everything in your portfolio, even though you think the prices suck. So there are real advantages to having a venture fund, I think.
Get it. Thanks so much, David.
Cool.
I have one last question.
All right.
Hi, David. Great to hear you, and thanks a lot for the insightful stories. David, you said before that you learned quite a lot from the recent events. Kind of how did you change your strategy now, or like what are you guys changing now going forward?
A lot is the short answer. We haven't really kind of communicated publicly on it. Is this Philip? Is this going out? Is this going to be available?
Yeah, we'll post this on our website. So if this is public, then probably you want to keep that. Like
we can chat offline if you want. But high level is, I think that what we've seen at least is a bifurcation between sort of institutional money looking to get into the space on one hand, and what they want is something plain vanilla. Like above all, they want kind of safe access. So they want to be able to say that they have a crypto product. It needs to make some money. The volatility needs to be much lower because they don't want to have a 50% drawdown. But apart from that, that's sort of, I think, the end of what their mandate is. And then on the other side of things, you have, I think, very interesting kind of smaller opportunities for people that are really unconstrained. And I think the way in which you approach those two things is very different. One of them sort of like a very institutional approach, white glove with all the bells and whistles. The other one is sort of like, the ideal, I think, would just be to raise capital on balance sheet and do these things like out of your own balance sheet where it's permanent capital and it's totally unconstrained. Or set up SPVs and just call up, your list of investors and say, we've got something interesting. Do you want to kick some capital in? You have 2 days to decide. I think that's the general direction.
Thanks.
Yeah, sounds really interesting, and looking forward to what those additions are and what you're gonna do next, David. And thanks very much for joining, David, and everybody else.
Thanks for having me.
And talk to you soon, and see everybody next week.